Hello and welcome to our live webcast, Keep Friends Close, Suppliers Closer, Valuing and Managing Suppliers Strategically. Thank you for joining us today. My name's Tim Wilson, and I'll be the operator for our presentation. We are joined today by our speakers, Richard Waugh, Vice President of Corporate Development at Zycus, and also with us, we have Gerard Smith, President at Global Risk Management Solutions. So at this time, it's my pleasure to turn the microphone over to Richard Waugh. And Richard, the audience is all yours.
Thanks so much, Tim, and thanks everyone for joining us today. I do think we have a very exciting and action-packed agenda for you today, and our topic is keeping friends close and suppliers closer. And in that context, we want to talk about SRM, which originally came to mean Supplier Relationship Management. But today we want to focus on supplier risk management and how SRM is morphing and evolving into a focus more about just who are suppliers and how do we contact them to what do we really know about these suppliers. And after all, suppliers can provide a lot of upside in the form of new product innovations or cost advantages, but what are some of the downside risks and how do we measure and mitigate against those risks? So that's really our focus for today. And just before we get into the agenda, a little bit of context about Zycus. So Zycus is a suite of source-to-pay tools, an integrated suite of modules that span sourcing and procurement across activities like spend analytics, sourcing, contract management, procure-to-pay, et cetera. And included in that suite are supplier management-specific tools that really enable more self-service information provision by your supplier. So, an opportunity to offload more of that work to suppliers. But importantly, in conjunction with that is the need to, as they used to say during the Cold War times, trust but verify. And pleased to be joined by Gerard today with GRMS, a partner of Zycus that really extends the capabilities to really get at that validation and verification of suppliers that's so essential in the domain of supplier risk management. So let me preview for you the agenda that Gerard and I will cover today. We first want to talk about what are some of those challenges. So let's scope the problem. We'll look at some best practice ways that different organizations are defining supplier risk, and also go through some steps, again, best practices that are being utilized to, number one, establish a risk management program within the organization, and then how you proceed along that path, starting with segmenting and prioritizing suppliers, and then screening them for risk, performing supplier risk assessments. Now, part and parcel of this approach would be, how do I get funding, budget approval to establish a program? So how do I measure the value? What are the key metrics and ROI drivers? And Gerard in particular will share with us some real-world best practices for what to really focus on, what to screen for, how to do it most efficiently and effectively going forward. So that's our agenda for today. And first we wanted to start with some of the challenges. What are the supplier management challenges and some of the solutions that are available as well? And, first, the scope in and of itself is pretty daunting. If you look at the number of suppliers that most organizations have to manage on a global basis, and this benchmark data comes from the Hackett Group, and they differentiate between direct material and indirect suppliers. But overall, the average company has about 6,000 suppliers per billion of spend. Now, there are clearly fewer direct material suppliers that, are really core to the business and very closely watched, but that number proliferates greatly when you look at the indirect side. So nearly 10,000 suppliers per billion in spend on the indirect side. Now, one of the things that's clear if you differentiate or contrast between world-class performers and everyone else, the non-world-class, world-class organizations have really focused on supplier rationalization. So overall, they have about a third of the number of suppliers, less than 2,000 per billion of spend, compared to the average companies that they have to manage almost 6,000 in total per spend. So that's number one. One of the strategies here is how do I get this number more manageable? How do I rationalize it to really make achievable, the goal here, because the proliferation of suppliers makes it more and more difficult to truly manage those relationships and manage the risk. Now, another challenge, of course, is just the volume of data itself that's being collected or that organizations want to collect about suppliers. And the fact that in many cases these different types of data reside in a myriad disparate systems, so it's very hard to get one version of the truth. So this matrix, again from Hackett, compares the satisfaction of the data that organizations collect, the satisfaction that they experience, to the relative importance of that data. And as you can see here, there are numerous different data types, but higher satisfaction, relatively speaking, with data types that are most readily available, public information, for instance, about the company, their TIN number and SIC codes and ownership structure, maybe parent-child hierarchy, and those kinds of things. And to some extent also, again, mostly publicly available data on financial risk, their credit ratings or financial performance, things that can come from 10K reports and those kinds of things. And as we move down this pyramid or this matrix, if you will, we get into lower satisfaction levels with those types of data that require more analysis and verification. So when it comes to how are suppliers delivering from a performance standpoint against my KPIs for cost, quality, service of delivery, et cetera, that requires more analysis, more difficult to get at. Or verification around compliance, things like OFAC, OSHA, or various types of insurance coverage, EPA, all listed there. So those tend to be more challenging and lower in importance, but lower still in satisfaction are areas where they recognize global challenges, the need to get country-specific data, that's really pertinent to a specific region or country around the globe. And of course, relatively low satisfaction with the ability to incorporate unstructured data, news feeds, and those kinds of things that can give predictive signals to when suppliers might get in trouble financially or there might be a pending M&A activity, those kinds of things. So clearly one of the big challenges is the variety of types of data, the need to do more analysis and verification, and the need for most organizations to aggregate this information. How do I find it in one place instead of having to search across multiple disparate systems? The process itself is challenging. So this diagram reflects a typical kind of a supplier onboarding process, which in most organizations is, given the number of touch points and the number of handoffs involved here, very time-consuming and requires extensive stakeholder collaboration. So it's not just the procurement category or commodity manager that's involved here, but often various other internal stakeholders from finance and legal, the compliance office, maybe quality involved as well, and lots of different documents being collected, lots of different sign-offs having to be managed so that you can actually get a supplier onboarded. Now, today, most organizations attempt to capture much of this information using their ERP system and the vendor master file that's in there, but what they found is that there are significant limitations, that for the most part, the amount of information they're able to capture through those ERP-type tools can be limited to simply what it takes to get an invoice paid through accounts payable. If I know the supplier's name, ID, remit to address, and those kinds of things, that may be the minimal type of information. But here, as you can see, to onboard that supplier in a compliant way means gathering a lot more detailed documentation about that supplier and engaging a lot of different stakeholders as well. So that's certainly a challenge. Another key challenge that most organizations face is simply, how do I get budget approval? How do I build a business case? So almost intrinsically or inherently, they know that supplier management and supplier risk management is something that's critical, that's strategic, that they should be focusing on, but how do I build a business case or ROI for those? So here, sharing some helpful metrics. One, for instance, that comes from a Spend Matters study that looked at supplier management ROI, making a hard dollar business case. And kind of going back to the process chart that I just covered, they kind of looked at what is the cost sort of from an activity-based costing standpoint of all those different stakeholders that need to touch that supplier information to get them onboarded in the first place, and then keep that supplier record up to date. So they figure that the cross-functional cost of gathering and managing that supplier information is on the order of $150 to $225 per year, and that the benefits of automating supplier information management, utilizing new technologies like portals that allow suppliers to upload and maintain more of that content themselves, can drive a productivity benefit on the order of about 20%. So that equates to average savings of about $30 to $40 per supplier per year. So extrapolate that for a very large organization that has 10,000 suppliers, that could mean a savings of $300,000 to $400,000 per year. So non-trivial. And even more detailed analysis from Hackett, I won't go into the details themselves, but it really looks at what is the maintenance cost of keeping those records up to date, because on an ongoing basis, the information about suppliers changes fairly frequently, that you're updating those supplier records, and each time you do it, it costs $13, or item records, an individual item within the supplier record, $5 each. So they extrapolate a typical situation with that kind of frequency, that the savings could total more than $100,000 just there. And that's not to mention all of the sort of more strategic benefits of getting closer monitoring of suppliers and avoiding potential risk events, merely looking at the process efficiencies here to build a business case for investing in this type of technology. So talking about the technology, what to look for from a best practice standpoint, in the area of supplier information management, it's the idea that I can create a centralized repository of supplier data. Not only that, that I have a supplier portal that enables self-service, supplier registration and maintaining of that, and maybe even scores that information according to my KPIs, what's important to me, so that I get an initial screening of the capabilities of those potential suppliers. For instance, if they fall outside of my tolerances for risk, and either in terms of the size of the company or things like liquidity ratios, those kinds of things, financial measures or otherwise. And this is a way, of course, through the self-service portal for suppliers to upload their certificates of insurance, diversity certificates, and those kinds of things. And on an automated basis to check to make sure those suppliers are not on any kind of a blacklist, so they're not someone I shouldn't be doing business with in the first place, and through approval workflow, make sure that the right people are signing off when a supplier comes on. And at the end of the day, a supplier information management system, a supplier portal like this, needs to integrate back with the ERP system and the vendor master file as the system of record ultimately. So that's on the supplier information management side. What to look for from a supplier performance management standpoint is the ability to create scores that track supplier performance over time, indicate trends. So you have sort of the red, yellow, green stoplight metaphor here, and of course you want to pay a lot of attention to any of those that are in the yellow or red vein, because they require remedial action to make sure that they get back on track. But it's the ability to configure according to your KPIs and actually integrate and harmonize both qualitative and quantitative data. So on the qualitative side, being able to survey stakeholders to rate and rank supplier performance, and from a quantitative standpoint, pulling in data from transactional systems to measure things like on-time delivery or quality, perhaps as measured in defect per million parts, and those kinds of metrics. So that's what to look for from a tool standpoint. I wanted to share a specific case study of a client that's actually implemented these tools, very large company, and but I think has some of the typical challenges that organizations of all sizes and stripes would encounter as well. So in this case, a very, very large company with a highly sophisticated, complex workflow in the oil and gas industry, which is highly regulated, and dealing with a significant volume of suppliers, so 50,000 suppliers, and over 1,000 end users across the business that have to weigh in or provide information about those suppliers. So historically, their challenge had been an extremely elongated and complex onboarding process, taking a full year to get a new supplier on board. It's 52 weeks. So perhaps more challenging than most, but most organizations would recognize whether it's, even if it's not a year-long process, it's too long and it's too cumbersome. So the solution here was to deploy supplier information management and configure the unique workflows, including conditional logic, because not all suppliers are alike, that really manage that process on a supplier-by-supplier basis and the steps involved in that workflow, and being able to measure the specific KPIs while onboarding suppliers. So this gives you a preemptive and predictive view of which suppliers could potentially be risky. And in that context, really, from a preventative standpoint, don't enter into business with suppliers that fall outside of your risk tolerance, if you will. And the impact now is that they're able to do true 360-degree regulatory checks across a number of key attributes that they want to track that include a number of risk factors, whether it's measuring and monitoring for child labor practices or environmental standards, really looking at diversity as well as green in terms of the carbon footprint for those suppliers. So let's talk a little bit more. We talked about supplier information management, especially the number of suppliers to be managed, the way they get onboarded. Now let's talk about more specifically the topic today, supplier risk management. And again, I'm going to borrow from Hackett here, a very multi-dimensional slide, if you will, to first just make the case that risk is much more than just supplier risk, that a holistic assessment certainly looks at supplier risk events, but also external market forces or what's going on internally within the organization, as well as technology-related events. Coming to the fore in the whole domain of supplier risk management is the area of data privacy. It's top of mind in the news with emails getting hacked as part of the election process, as an example. So more and more focus on all these different aspects of potential sources of risk, and it's not just from suppliers, but it could be in the form of other partners, be they alliances, joint ventures, outsourcing providers, et cetera, and also within the external framework or context of what are the regulatory compliance challenges that are bearing down upon us, be it the Foreign Corrupt Practices Act, the FDA or environmental health and safety regulations, or financial regulations like Dodd-Frank. So that's the big picture view of risk overall. Now, specific to supplier risk, again, from the Hackett Group, they've produced a top 10 list, if you will, of supplier risk sources. And, one is, a variety of sort of geopolitical type of risk things, whether it's, instability from an economic standpoint in different parts of the globe, political instability, changes in the regulatory environment, different movements in the market from a competitive standpoint, such as merger and acquisition activity in the supply base, certainly price focus, protecting against the potential for price escalation and maintaining the assurance of supply are all key items on this list. And coming to the fore more and more frequently, as I just mentioned, is this, in the technology age, the focus on data privacy, data loss, or theft as a potential risk event. So what tools are organizations currently using to try to manage their risk? So a lot of different types of technologies implemented here, and this study actually found that the most frequently used platform is Microsoft Office. So a very valuable tool for each of us in our day-to-day productivity, but hardly state-of-the-art when it comes to managing and monitoring risk. So, a long way to go here. Obviously, this data looks at future plans as well as current adoption. So lots of organizations are focusing on this area and intending to adopt, more leading edge type platforms, move beyond the Microsoft Office suite, for example, and often that means adopting, a spend management suite such as the Zycus tool set, or it may be tailored solutions for governance, risk and compliance, or purpose-built niche tools for supply risk specifically. But one comment here is that these various tool sets are not necessarily mutually exclusive. Many will be used in combination, but the key tends to be, how do I find one tool that's going to be my central repository, one place to go for supplier information that may be fed by other sources as well. So it has to be open and integrated to those other tools. And ultimately, it also has to integrate back to my ERP system, which is likely not capable of capturing the richness of data and the various types, but ultimately needs to be updated as a system of record as well. So lots of new tools, lots of emerging and innovative technologies in the space, and a long ways to go from the current state, which is most trying to manage this through, Excel spreadsheets and those kinds of things. So what are some of the drivers for supply risk management programs? So Hackett actually studied this as well, and not surprisingly, the number one driver has probably been the one that's traditionally been invoked the most often, is procurement's role to at least ensure supply continuity. So sort of procurement's version of the Hippocratic oath of do no harm. At a minimum, procurement needs to make sure that the business has, especially on the direct material side, those components or commodities that are critical to run the business at a minimum. But more and more, focus as well on not only do no harm, but don't get us into trouble. So how do we make sure we don't run afoul of the various type of regulations that we have to be in compliance with in our industry? So those top two, and in particular on more of the core strategic, often direct materials, but the one that comes into play more and more frequently on the indirect side, less about ensuring continuity of supply and more about ensuring supplier financial viability. So that's the area, again, where you have a great proliferation, many more suppliers to manage, less insight to those suppliers, and you really need to know where you're exposed, especially from a financial standpoint or even price fluctuations, as mentioned here as well with regard to those suppliers. So those are some of the drivers. Challenges organizations are facing establishing supply risk management programs. First and foremost, that procurement's held responsible for supply risk, but not getting the resources. So, really being given all the responsibility, but not having the wherewithal to make it happen. Next is being reactive, that mostly procurement reacts rather than being proactive or predictive to potential sources of risk. And the other one, the one we addressed a little bit, how do I put together a business case? Where do I find hard dollar ROI justification, and that it's not just seen as an insurance policy that we take out and we hope to never file a claim, but it's just a pure cost, that there's no savings as well. So, really an area more organizations are looking at, how do I build a compelling business case? The other challenges are just simply the sheer coordination cost. It's too big a responsibility, too many stakeholders, or that it's no burning platform. If we haven't had a major issue yet, we're not going to invest until something bad happens, and then we'll take action. And the last one, of course, that measurements are simply lacking to really identify what the benefits are. So with those challenges in mind, again, Hackett offers us a step-by-step sort of best practice for going about establishing a supply risk management program. I won't go through all the details here, but essentially through these 9 steps in this process, it starts with creating a charter. Know what kind of risks you want to measure. Step 2 is getting your arms around the data. How many different systems does it reside in? What type of data do we need to gather? How are we going to aggregate and gain visibility to that data? And in step 3, you start monitoring and really looking at the supply base for potential problems or opportunities to reduce and mitigate risk. In fact, step 4 really focuses in on that mitigation. So creating mitigation plans, contingency plans, if you will, once you've identified the different potential types of risk events that you will need to manage ultimately. Step 5 is really prioritizing. So for many organizations, I mentioned in the case study, the oil and gas company had 50,000 suppliers. So you can't really perform the same level of due diligence or risk monitoring on all 50,000. How are you going to segment and prioritize which ones are the most critical? And step 6 really talks about predicting. Getting out in front of this, identifying the potential risk events by supply category before they happen. Step 7 is about measuring. Measuring the overall risk levels. And that leads into step 8, which really means creating a risk score that helps you assign a monetary value to potential risk events, which will ultimately be critical in measuring the effectiveness of a supply risk management program. To what extent have you been able, for instance, to reduce those overall risk scores? That represents a real benefit if you can express it in monetary terms to the business. And step 9, of course, is then refining that approach, especially in light of, when we talk about supply risk, so much of it deals with the unknown, but there are some known events. There's a major election coming up. We all know that. What could the potential impacts be from a risk standpoint and planning for those and predictable weather events and those kinds of things? There's more and more information available today. So how do I integrate that to get out in front of those potential risk events? So how do organizations today measure the value of their supply risk management programs? Most are productivity or efficiency based. They're looking at the number of risk assessments that they've completed, for example. But many are also starting to score that risk reduction. How have we been able to reduce our exposure? That certainly demonstrates value. But, I think pretty revealing as well is, just as many are not quantifying at all, 27%. So many either don't measure or really haven't sort of figured out what the right metrics are to measure. So certainly an area that presents some challenges. And then when it comes to measuring costs, an even greater number here really don't have any cost metrics. They don't really know what their investment in the risk management program is. Some are looking at their assessment, monitoring costs or process costs and those kinds of things, or benchmarking against external market costs. But for the most part, nearly 3/4 say they really don't have cost metrics in this area. So it's clearly an emerging space, that is getting intense focus today. One of the measures for how significantly organizations view supplier risk management is sort of a measure of, are you putting your money where your mouth is, and how are you budgeting and allocating resources? And I think one of the things that's really interesting here is that overall, top performing organizations are actually doing more with less. So the number of total procurement FTEs per billion in spend is actually lower for the best performing organizations, about 44, versus the average or peer group overall, which is almost 60. So about 27% fewer resources in total from a procurement standpoint for the world-class organizations. But the resources that they do have, they're allocating a disproportionately higher share to supplier risk management specifically. So about 6.5 times more FTEs allocated for the top quartile performers, about 13, compared to the bottom quartile, just about 2. So overall, fewer resources, more efficiencies. They've introduced more productivity and automation. But with the resources that they retain, they've decided strategically it's critical that they allocate a higher percentage to supplier risk. Now, executing supplier risk means conducting supplier risk assessments. So I think it's helpful and instructive to look at what are the key criteria that are most often used. So typically it's a result of that segmentation, first and foremost, that I categorize certain suppliers as strategic or critical to the business. That may mean that they also have a lot of spend with those suppliers, but it could be, there are examples of, a very what would seem to be a very trivial kind of a part that's very cheap to manufacture, but an outage of that supply or a critical supplier that no longer provides it can shut down a production line. So it's not always a measure sheerly of cost as far as the criticality of a particular supply or supplier. And of course, what bubbles up to the top here as well is where there's already been a risk event, a high risk exposure type event with a given supplier that's been identified. They're of course going to be at the top of the list for risk assessments. And of course, as you go down, spend is clearly one of the important type of criteria, as well as just sort of from a timing standpoint, where are we in a contract renewal cycle and those kinds of things. So it's important to have, a set of clear criteria because no one has infinite time and resources. So if you can't perform a risk assessment on all of your suppliers, you're going to have to segment and prioritize which ones you're going to focus on from a risk assessment standpoint. And when it comes to those assessments themselves, this benchmark data from Hackett kind of tells us how frequently and for what type of suppliers most organizations are in fact performing risk assessments. And here I think the results are a little mixed, probably a lot of room for improvement when you consider that for 75% included here, they're only doing a risk assessment for individual suppliers that have spend of $500,000 per annum or more. So, of course, especially when you get into that long tail of suppliers, they may fall below that threshold, but you aggregate all of them. There are so many that in aggregate dollar terms, it can represent a significant component of exposure that's not being assessed at all. And likewise, the same percentage, 75%, perform those assessments annually or less frequently. So in some cases, they're doing it every 2 years, every 3 years, but just 25% are doing the supplier risk assessment more frequently than annually. And given the dynamic nature of the supply markets that most of us are dealing with, we know that the pace of change is really much more frequent, and that represents some real exposure there as well. So just some, I think, helpful benchmarking on areas that organizations are focusing on from a supply risk management standpoint. What are the techniques they're using today? Where are there some gaps and opportunities for improvement, as well as where can technology really help address a number of these things? And now I'd like to sort of segue and ask Gerard to come in and drill down on sort of some very practical and real-world examples. We've seen the benchmarks. How are organizations really implementing supply risk management programs today?
All right. Well, thank you, Richard. Tim, why don't you do you want to explain the poll question?
Certainly, and the polling question is on your screen right now. Question being, when and how frequently do you perform supplier risk assessments? And we have 4 options for you: only at setup and initial onboarding, also at setup and at least annually, at setup and less frequently than annually, and the 4th option, no supplier risk assessments performed. So make the selection that represents your opinion or your situation by clicking on the radio button to the left of the answer, and your participation is anonymous. We'll share the results here momentarily. Also, I do want to pass along that At any time, you may submit a question by typing it into the text box on the right side of your screen. So we'll give this just a few more seconds here before we close things out. The results are coming in. All right. Let's give it 10 more seconds.
So, Gerard, any reason to believe that there will be a significant variance from what we saw in the benchmark data, where 3/4 are doing it doing risk assessments annually or less frequently?
Yeah, annually, and the term annually is it's set up where we collect the COI and the W-9, et cetera, but how frequently are we actually reviewing and looking again at the supplier? So it'll be interesting to see whether it matches what Hackett had suggested.
And we're sharing the results with the audience right now. The biggest percentage, 35.5% of those with us today, said at setup and less frequently than annually. That was followed by 28.9% that said at setup and at least annually. And then about 21% said only at setup and the initial onboarding. About 15% said no supplier risk assessments are performed. So, Gerard, I'll turn it back over to you for your comments.
Well, I appreciate it. Compliments to those of you on the 29% where you're doing it at setup and at least annually, because more and more companies are recognizing the importance of screening the suppliers and managing them from a risk perspective. So I'm going to go ahead and going through the first chart. Why don't we close that box? Okay, so I'm going to go through some specific examples then of addressing what companies are currently doing. And really, this is the problem. Statistically, currently, more than 80% of companies conduct some type of background checks on their full-time employees. Less than 20% do any type of due diligence on their suppliers. And with this gap in due diligence, it's really a significant risk for companies that can't be ignored. As a result, knowing your suppliers and managing compliance are now really top corporate objectives. So a lot of companies are attempting, as we see in the survey, the poll, managing internally versus outsourcing the function. It is, as Richard said, a very dynamic area. And one of the questions that a lot of companies are addressing is it in real time versus is it something that we get something in the beginning? I come out of procurement. We used to collect the certificate of insurance, the W-9, do the financial review when we actually signed the contract. But after that, we didn't necessarily review it on an annual basis. And that's becoming more and more prevalent as a best practice, that at a minimum, that you should be reviewing the financials as well as collecting the appropriate documentation. And that may be anything from conflict mineral documentation to California Transparency Act, child labor. There's a variety of things that companies are concerned about, and it truly falls on procurement to manage a lot of this. And so what I want to do is share some ideas of what companies are doing in terms of their particular programs and what can be included in particular type of programs. So with that, we want to do a second poll to understand a little bit clearer, a little bit more deeper dive, if you will. So, Tim, why don't you take that?
And again, the question is on your screen. Which of the following do your supplier risk assessments include? Third-party verified versus supplier self-reported? Consistent measurable standards? Geographic or commodity-specific criteria? Or none of the above? So again, there should be a little radio button to the left of each answer, so make the selection that you feel represents your opinion.
And again, Gerard, any predictions based on your experience where, perhaps organizations are collecting some information, but when they get into, getting down to country-specific or commodity-specific criteria and qualifications, that poses a challenge, or that they're not often able to verify, certainly with independent third party, the information that suppliers are self-reporting.
Yeah, and that's exactly right. Oftentimes there are sources available, but it's primarily self-reported information, which is then reliable only in as much as the truth of what a supplier is telling you, versus third-party verified, where you're actually adjudicating or verifying everything that's being provided, whether it be a document or even a data, and I'll explain that in a couple of minutes.
And why don't we go ahead and share the results for which of the following do your supplier risk assessments include? Just over a third of the audience said consistent, measurable standards. About 25% said third-party verified versus supplier self-reported. 22% said none of the above. And about 19% said geographic or commodity-specific criteria. Gerard?
So, yeah, with those results, we see that about 25% of the participants today are using third-party services to try and manage their suppliers, providing then that consistent measurable standards in as much as that they're more reliable when it's a third party that's verifying it versus self-reported. And we discussed that a minute ago. 20%, then 19% are talking about that is geographic or commodity specific. And I'm going to, again, give you some specific examples of what companies are doing to address their specific requirements. So let me go through an example of what some key components of world-class supplier screening programs include. And I broke it down into 4 boxes here. So the first top left, the objective is to screen individual suppliers, as Richard said, either based on geography, on risk, on spend. What you'll find is that, as Richard alluded to earlier, that the small spend suppliers are not necessarily the ones that you can assume that they have insurance or that they are providing everything that you need. So it's not necessarily based on the amount of spend that you're spending with a particular supplier. But unique is that there are different requirements based on different types of suppliers and also based on geography, whether it be in EMEA, whether it be in Asia Pacific. There's a lot of variables, so we need to be able to have a customizable program that manages suppliers based on their particular risk or geography. The second box to the right talks about the adjudication of all data returns for false positives. What that means is that oftentimes what will happen is you can take a supplier, and let's say you compare it against the OFAC list. And I'll give you an example. Recently, we got a call from a company that had tens of thousands of suppliers. They asked a third party to check the OFAC list. The third party just simply pinged it against the list and came back. I think they originally had 80,000 suppliers. The third party that had done the exercise for them came back and said, you have 7,000 potential hits. The reason that happened is they simply just pinged it against the list and came back and gave the hot potato back to the client. And the company now has a huge problem because they now have to do something with that information. So now they have to verify 7,000 companies where they are indeed the company that's listed on the OFAC list. So there are services that provide that adjudicating of data-based false positives. You have to verify that indeed the company that you're speaking about is indeed the one that's on the OFAC list. And just as a matter of fact, there are well over 1,000 governmental lists around the globe like the OFAC list. The OFAC list is under the Patriot Act. It basically says that you should be checking every supplier that you pay that is non-personnel expense. You should be checking against the OFAC list. It could be an individual, it could be a company. Most procurement organizations are not familiar with it, but that's a law that's required that you actually check against the OFAC list every supplier you pay. The other part of that box talks about validating all documents collected. And what I mean by that is oftentimes we'll get a document, a certificate of insurance as procurement, or even a W-9, and we simply put it in the procurement folder. The problem is it doesn't meet the requirements. In other words, with a W-9, according to the IRS regulations, you have to confirm that it's the current version, which is 2014, that it's signed, and that it's dated, and it's completely filled out correctly. So if you have a supplier that you've been using for 10 years and you have an old W-9, you technically could be penalized then by the IRS for not having a current W-9. And probably more importantly is the certificates of insurance. You know, when you collect a certificate of insurance, you have to verify that the additional insured language is on there, and you have to collect all the right endorsements. And in our experience, which is an interesting statistic, we find that over 90%, and that's a huge number, over 90% of the certificates of insurance are found to be failing when we implement a program. So the idea would be you can collect a certificate of insurance, but what happens if no one's monitoring it? What happens if a supplier doesn't pay the premium? What happens if they try and reduce the amounts? With a 90+% failure rate, that means every company that's represented on here, because it's literally every company we've ever worked with, over 90% of those suppliers, and they're providing perhaps parts or they're coming on property or whatever else, they have created a liability, because if they don't cover you with the insurance, then your company's held liable potentially. And so there's the problem. You need to manage the certificates of insurance literally continually, and you have to ensure that any document they provide is, again, validated. Now, on the bottom left, we talked about third-party verifiable supplier information in real time. There are searchable databases out in the marketplace, but it's basically for a sourcing tool, if you will. The objective here is that you have to screen the supplier in real time. As Richard said, there's financial responsibility, financial, you have to verify the financials of a supplier before you write the contract. And the idea would be that it's procurement's responsibility to ensure before you write the contract that the supplier can actually perform. So we recommend that you rescreen the suppliers annually. So obviously you're wanting to screen them when you set it up. As the survey showed, a lot of companies, nearly 30%, set up and at least do it annually. That would be considered a best practice. You want to do it a minimum on their anniversary date, if not more frequently. But again, the continuous management of the certificate of insurance is crucial for procurement to be aware of, because of the fact that there's a huge liability attached to that, as there is with federal laws like regulations when it comes to the conflict minerals or Federal Healthcare Fraud and Abuse Act or other things like that. If you are a retailer or manufacturer in the United States, you have to be concerned about the California Transparency Act. Perhaps if you're dealing in Europe, the REACH, ROHAS, FCPA requirements. It goes on and on and on. So if you're in procurement and not aware of it, you want to become educated about these different areas, because it does affect you. And when you're selecting a supplier, especially as you're sourcing globally, you need to make sure that you are vetting them correctly and ensuring that they can perform what the requirements of the contract is. Now, on the bottom right, we talked about provide consistent, measurable compliance standards globally. One of the objectives is that you want to set up the criteria in advance and be able to manage to that criteria. So in other words, as Richard said in some of the slides, you have to have this predictive approach in terms of reactive. Clear criteria is established. Do they actually meet our criteria or not? And now you can make a good business decision whether you want to do business with them. So again, the objective would be to set up the criteria in advance, be able to screen individual suppliers based on a particular geography or risk or spend, et cetera. And then when you collect the documents, be able to validate all the documents collected, that you're just not taking it as their word. We've seen in many cases where companies say, we want you to upload a certificate of insurance in our system, but because no one's looked at it, it literally could be a blank page, and the computer believes that there is a COI there where it is not even in existence. So then moving on to, what does a typical enterprise-wide screening package include? Because I want to give you some ideas of what best practices are based on some of the questions I can see. That's one of the ones that people are asking. Most of the time, there's a base package that companies work with in terms of, we want all of our suppliers to provide us some specific information. It's sometimes based on a survey. It's based on all sorts of type of documentation. But the objective here is, again, we just put 5 circles, and then they build on that. So on the top, we put the global watch list screening. As I mentioned, not only you're required by law to check the Patriot Act on OFAC list, but those 1,000-plus international government watch lists. How are you managing to those? Because you don't want to do business with anybody on any governmental watch list around the globe, so you have to be aware of it. Basic financial review. The objective here is, whether they be private or public, are they financially stable? And again, this is one of these ideas that you want to check this annually, because if they're getting into financial trouble, how will you know that? If they are providing products to a production line, if they go bankrupt, how will it affect your organization? The next circle is the certificate of insurance management. We talked about that, how important it is to not only collect the COI, but to ensure that you have the additional insured language and that you collect the right endorsements. If you have a supplier that's working on your IT system, for instance, you need cyber. You need a specific insurance policy to cover that particular issue. So again, that customization is extraordinarily important. The next one is tax documents, and I use an example of the United States here, whether it be a W-9 or W-8. Again, you want to collect them, but you have to visually look at them. You can't just take them and put them in the file and assume they're correct. Someone has to look at it, and they have to be attainable by your finance organization, because the IRS requires that they have the complete set. And then on the last bullet is this disadvantaged business verification. Again, this is a U.S. issue, but if a company claims to be small or minority owned, the problem here is if you don't verify that, your company could be taking tax credits for doing business with a small minority-owned business. The problem here is that you have to verify it. So there's a number of issuing agencies in the United States. You have to verify it from a variety of different sources, and perhaps you have to require that they provide you the actual certificate to do so. But again, this is an objective of yours. It should be to verify all this information. So now we have a baseline package. Now the question is, where do we go from here? And so this chart shows some examples of where different risk exists and how there are screening components that can address those particular requirements. And so as you look through each of these, enterprise-wide, obviously we talked about those. Legal, perhaps you want to do a search on bankruptcies, liens, and judgments. You might do what's called a corporate record search, meaning are they really who they say they are at the address they are? Are there multiple companies at that address or phone number? The Ucc Search is the Universal Commercial Code. What that does is basically it's a lien. If they stop paying, the UCC filings pop up, and what happens is it shows it's a predictive ability for you to see that your supplier is getting into financial trouble. On health and safety, which is becoming extraordinarily important in many areas now, we have OSHA, we have EMR, obviously we have health and safety and environmental surveys we can do. There's a variety of things you can do to address this, but again, it's not an area you can ignore. Regulatory, we've talked about conflict minerals. That's becoming more and more prevalent, obviously, for manufacturers, Reach and Rojas. I'd mentioned federal healthcare fraud and abuse and FCPA. FCPA means the Federal Corrupt Practices Act. And so that is, again, another thing that you as a procurement person or sourcing person would need to be aware of, because that's, again, a regulation. And now reputational, Richard talked about the global adverse media. There are searches you can do that's global to say, is this company showing up anywhere in the media around the globe? And if it is it positive? Is it negative? Are they buying companies in the M&A sphere, or where are they exactly going? Then corporate sustainability is becoming more and more of an issue to address that. The forced and child labor, of course, especially in certain areas, we see that more and more in the news. That's becoming more and more prevalent. And then for international suppliers, there's a whole different set of criteria where you're talking about denied parties and governmental watch lists. As I mentioned, there's well over 1,000 around the globe that we're trying to manage to in real time. So you have to be aware that based on the base package, then you can add specific criteria based on the type of industry you're in, based on the type of supplier, based on the geography, et cetera. But hopefully this gives you some ideas of what you may want to be considering to include in your particular programs. So with that, that kind of gives you a little bit of an overview of what can be included. I'm hoping the questions will be specific and so that we can address them. So, Richard, did you want to address anything that I just went through?
Yeah, thanks, Gerard. And Tim, I guess we have a few minutes for questions. I will mention we'll respond to all the questions we don't get to via email. But maybe we have a few minutes to take a couple of those. One of the ones that came in, Gerard, you had mentioned that 80% of companies do screen employees, but only 20% for suppliers. So with the trend towards contract labor, shifting from employee labor to third party or contract labor, any advice or tips you can give on how to screen in the area of contingent labor, this whole gig kind of marketplace or workforce for contingent labor?
Well, our focus is on the supplier screening versus the individual screening. My issue is more of the fact that under the Patriot Act, you have that OFAC list, and the OFAC list includes individuals and companies both in the United States and globally. And basically, and I'm really dunning it down, but basically it says anybody you pay, that's non-personnel expense. It could be a company, it could be an individual, independent contractor coming in. But the idea would be is you're supposed to check them against that OFAC list. And most companies are not doing that, which is creating a liability that potentially could cost millions of dollars in penalties. And so for us, the focus right now is getting companies to understand that we have to establish the criteria and we have to manage to that criteria. proactively, as you said, versus reactive. When something goes bad, that's usually when we get the call asking for help. I know it didn't answer your question, but if you're talking about a company, an individual that represents themselves as a company, you definitely want to screen them. If they're an individual, you still need to check against the OFAC list, even as an individual.
Excellent. We had another question about the potential impact to the company's brand and reputation, and maybe you can comment on areas. You mentioned, for instance, monitoring news feeds and those kinds of things to kind of see if something is trending negative on a given supplier that could potentially impact the brand. But what would your advice be on areas to monitor and screen and hopefully prevent any events that could damage the brand or reputation?
Well, it's a very good point that it's both reputational and financial liability when we're talking about supplier screening. And so the objective there would be again to be proactive, as Richard alluded to. You don't want to end up in a situation where you write a contract with someone that's on a government watch list, not just the United States, potentially anyone, that you'll end up on the front page of a newspaper saying that you've hired people on governmental watch lists, or that bribes have happened in foreign countries and you've got an FCPA issue. So the idea, the whole presentation today is how to be more predictive and not being reactive. The idea would be to establish the program now to protect your company. That's where sourcing's responsibility ultimately is, although it's probably an enterprise-wide solution. The objective is sourcing needs to be the driver in this.
Okay, and I think our poll showed only 25% are using third-party verification services today, and I think you've made a very compelling case for reasons why more would consider that. And of course, that prompts one of the questions that would naturally occur is, okay, what are the costs for the program, and how do you implement and roll it out?
Yeah, and that's, again, a very valid point. More and more companies are outsourcing it because it's simply too complex. The personnel expense alone for the certificates of insurance to manage them daily and to collect all the documents is very expensive. We recently heard of a Fortune 100 company that was interested, and their number one pain point in supplier screening was the fact that they had to collect all new W-9s this year. They needed to collect 60,000. They had no clue, so they were outsourcing it, looking for a solution to help solve that issue. So more and more companies are migrating to outsourcing the function. But again, this idea of real-time criteria versus searchable database, that's a very big distinction in companies that provide this type of service. Well, at the end of the day, it's basically you want to look for a service that provides this in real time, and that's able to manage it in terms of your company's specific criteria, not a generic criteria. The COI, again, has to have the additional insert language that names your company. So what's the cost involved with it? It depends on what company you go with. And again, I won't do a commercial for our company, but the idea would be there's some companies that are supplier-funded models like ours, meaning it costs your company nothing to use the service. Then there's other services that are subscription-based that would be once you gain access to the database and you can find the information, but it may not be real time. There are other companies that are doing a blend of the two. In other words, they charge the client and they charge the supplier. So there's no right answer here. It's whatever you're comfortable with. You need to find the right partner to work with you, but it really can't be an area to be ignored.
Excellent. And Tim, we got so many great questions. I think that tells us we're over the target. Which is great news. A lot of interest in this area. We'll have to follow up to answer all of them, but we really appreciate everyone submitting the questions and for joining us today. And I know you probably have a few closing comments as we're up against the hour.
I do, but first let me pass along a sincere thanks to both of you, Gerard and Richard, for a very informative presentation today. On behalf of the Institute for Supply Management and Zycus, I would like to thank our audience for participation in today's event. That concludes today's program, and have a great day.